Welcome to a brand new video. My name's Ian Phillips. In this video, we're going to be discussing Orange County real estate versus Los Angeles and see which one is going to outperform the other over the next 5 years or so. So if you're a buyer thinking of entering one of these markets, or if you're an investor and you want to allocate your money somewhere, this is going to be a good video to determine where could be the better area. Likewise, if you're living in one of these areas and you want to move to the other, also timing the sale and purchase of your replacement property, this video is also going to help you. So first, to determine where things are going to go, in my opinion, we need to break down the historical data, historical trends, and use that to determine which one is going to outperform over the next 5 years. So I actually wrote this article and I analyzed a bunch of data and I basically summarized it into this blog right here. So this is going to be a 20-year analysis and the 2026 outlook for both markets, as well as my 5-year prediction on which is going to outperform. I will also break down the current market in both of these areas and see what's a seller's market, which one's a buyer's market, and take a look at the inventory, buyer demand, median home value, etc. So part one to this video. A 20-year housing market performance between 2005 and 2026. So in between 2005 and 2007, we all know countrywide there was a housing boom. We had pretty low interest rates, very lax lending standards, and as a result, home values skyrocketed, which of course led to the Great Recession and collapse in 2008. So which one outperformed in the pre-housing boom that we saw? Well, both markets did pretty well, but Orange County led the charge with peak growth reaching 26% in 2004, 19.4% in 2005, and LA County was close behind, but Orange County inevitably outperformed. Now, during the crash, let's see if one or the other had a larger crash. Now, by the way, in parts of the country, some home values dropped by 50%. It was literally buy one, get one free in a lot of these areas for investors that were holding an enormous amount of cash. So 2008 financial crisis hit both markets pretty hard. Home values in LA and Orange County suffered significant double-digit declines due to the subprime mortgage crisis that triggered an enormous amount of foreclosures. Orange County carried a higher baseline price leading up to this recession, so dollar-wise, OC had a larger price reduction, but actually percentage-wise, LA was hit even harder. So the long recovery, tech-fueled surge happened after the 2008 financial crisis, and we are going to touch on jobs and economic expansion in both of these areas as well later in this video, because I do think that is a huge part of housing markets right now. We are seeing a ton of layoffs. We are seeing fewer and fewer job openings. So if you're considering purchasing, it's important to know what's happening in the local economy. So from 2013 onward, both markets entered a sustained appreciation cycle caused by low mortgage rates. And basically the Federal Reserve was in an economic easing environment post-financial crisis because they wanted to stimulate growth as much as possible. So construction activity happened in both counties, and that remained below the historic norms. We saw a pretty significant trend after the financial crisis that builders were a little hesitant to throw an enormous amount of money into expanding communities, building a bunch of new homes, because they were still recovering from this enormous housing crisis that we saw in 2007, 2008, 2009, and really a little bit of 2010 as well. So what happened in OC? Well, Orange County particularly benefited from the growth of technology. We saw a lot of large companies moving their headquarters here, and still that is happening right now. And as well as in the healthcare and aerospace sector, which drew high-income earners to communities like Irvine, Newport Beach, Aliso Viejo. And by the end of the period, OC's median home price had climbed to roughly $750,000, between 750 and 800,000, while LA lagged in the 550 to 650 median home value range. So this is kind of when Orange County started massively outperforming its neighbor, Los Angeles. Now, pandemic surge happened, of course. We saw interest rates below 3%, and buyer purchasing power soared. Now, both of these areas had a pretty large inventory crisis. There just weren't enough homes to keep up with the demand that we were seeing. And it was really in all over the country, to be quite honest, because interest rates were so low. But both LA and Orange County had huge price appreciation. Orange County posted 22.5% gain in home values just in 2021. Now, the shift toward remote work obviously turbocharged this demand for a lot of suburban and coastal living, and Orange County really saw a huge influx of homeowners and buyers into this market because there were just such a large range of areas that you could live. We have a ton of coastal cities here. San Clemente, more south, closer to San Diego. You have San Juan Capistrano, which is a little more inland. Then going up the coast, you have Dana Point, Laguna Beach, Newport Coast for the luxury, higher end communities. And then you have Huntington Beach even further up north. So you have a huge variety of coastal cities here in Orange County that LA doesn't really have as much of. But obviously, prices did increase in both areas. Orange County led over LA, which this is going to be a trend of the video. Orange County has continued to outperform LA. Median home prices hit $1.3 million in Orange County compared to $850,000 in LA. So think about that for a second. Between 2013 and 2019, the median home value in Orange County hit $750,000, and in LA, it was, let's say it averaged $600,000. But then over the next 2 years alone, home values in Orange County soared to $1.3 million, while in Los Angeles, only hitting $850,000. So yeah, it had a $250,000 median home value gain, but Orange County had an over $500,000 increase in the median home value. That just shows you how much more demand there was in this part of the country. Now let's go to 2022 to 2024, where the Federal Reserve started increasing interest rates to combat the 9% inflation that we had, and both markets really had a little bit of a correction. But during this time, we still had an inventory crisis. There were fewer buyers in the market because of higher mortgage rates, but also fewer homes available. And this was the lock-in effect that a lot of people were talking about, where a lot of people had sub 3% mortgage rates, and those homeowners weren't interested in selling to buy something with a 7% mortgage rate. So while we did have a correction in both areas, there still wasn't as much of a correction as other parts of the country because of lower and lower inventory in both areas. For reference, I want to look at what's happening right now and then the brief correction that we saw in both areas. So Los Angeles, you can see it peaked in 2022 around 1,033,000 and then went all the way down to 935,000. So about $100,000 price reduction. Now, if we go to Orange County, which peaked at 1,073,000 in 2022, then went to 1 million. So Orange County had a $70,000 price reduction, while Los Angeles had a $100,000 price reduction. So it had a larger overall dollar value drop and a larger percentage drop as well. So that is important to know that through history, we've seen when times are good, when the economy's booming, the housing market's booming, Orange County outperforms LA. When things get slow, interest rates are high, less jobs are becoming available, Orange County still outperforms Los Angeles. We see larger price increases in OC and smaller price reductions during housing corrections. That's important to know moving forward if you're someone that is considering purchasing in these areas. So let's see what's happening right now in the market. So we'll look at Los Angeles, which currently is in a seller's market, but is bordering that balanced market. Month supply of inventory is currently 4.1. On average, homes are selling 1% below list price, and the median sold price is a little over $930,000. So if we look at the last few years, Prices did peak in Los Angeles at 1,033,000, and where they stand right now, 935,000. So we haven't really seen we've really seen the higher interest rates preventing buyers from getting back into the market here. LA is also seeing, I'll touch on this a little bit more, but LA is also seeing the film industry moving out of the city, which is causing fewer jobs becoming available in this part of the country, which it has really been known for decades. So when you see a struggle in the amount of jobs that are being provided in one of its largest industries, that is, of course, going to have an impact in the housing market. So now we'll look at the Orange County chart trend, and you can see it's a completely different story. Yes, there was a correction in 2022, but now we're sitting at a new all-time high, roughly around $1.2 million for the median home value. So what's interesting is the median active listings right now is 1.4. So the 1.3 million that I touched on earlier is the median between the sold and the active. So when we talk about different sales prices, we really have to look at what's active on the market and what has been sold. And averaging out the two of them is kind of what you generally do when discussing the median home value in the market right now. So you can see this trend went down to roughly 1 million and has surged 20%. So that is already a stark difference between both of these markets, where we see the slump occur in both of them. However, Orange County recovered much faster and is now at an all-time high of around $1.2 million, while Los Angeles did have a price correction in 2022, but is still at those same levels to where the correction occurred. You can see prices are still down roughly 10% since that peak in 2022, and basically sitting at the exact same value as they were in 2023, roughly $930,000. So let's also now take a look at active listings, because inventory is of course a large factor. And there will be some similarities between both of these markets, but one is a little bit different, and we'll see that in a second here. So first of all, days on market is 45. Now, this always collapses at the end of every year because December, January are pretty slow markets, and generally speaking, the median days on market does increase as we get closer to the end of the year, and as soon as the start of the year begins, you can see the days on market does tend to decline. So active listings, we can see that in July of last year, there were 4,000 homes on the market, and now there are around 3,000 homes available for sale in LA. Versus Orange County, median days on market is 32. You can see the similar trend gets slower as we approach the end of the year. January, February roll around, and more buyers step into the market, homes sell faster. And inventory. Inventory hit 5,500 homes in July of last year, had a huge drop, and now is a little under 3,500. So Orange County did see more homes being removed from the market than LA. Now, this will be a combination of buyers purchasing them and sellers potentially not getting the price that they're looking for and just taking it off the market. So both have a similar trend, but you can see the sheer volume of homes either being purchased or removed from the market is substantially larger in Orange County. Let's move on to the next, which is pending listings. Of course, an indication of buyer demand, because pending listings is telling you how many homes are getting into escrow. And you can see Orange County has really been the same for the last few years. Even during the inventory crisis that we saw in 2022, there were still around 1,200 homes getting into escrow at the slowest time of the year, which was December. And obviously, as the year moved on, more buyers jumping into the market, more homes getting into escrow, this number increased to around 2,000. And that trend is happening right now. Buyer demand is increasing as the year moves on. Now let's take a look at Los Angeles. During the inventory crisis, there were only 700 homes getting into escrow at the worst of homes available for sale. And yes, this increased, but significantly less demand than Orange County, from 700 to 980 versus Orange County's 1,200 to 2,000 homes getting into escrow. So a substantially larger increase in terms of percentage and sheer amount of homes getting into escrow. So we see this trend over the last few years where as the year goes on, demand increases in both of these areas, but substantially more in Los Angeles. Now, sold listings is another factor, of course, number of properties. You can see the trend sort of matches buyer demand when we look at sold and pending in both of these areas. Bounces around, increases as summer approaches, decreases as we get closer to the end of the year. Now, month supply of inventory is a key factor and something that you should be monitoring if you're thinking of buying or selling in any market, really. Month supply of inventory currently 4.1 in LA, down from 5.7, and that has decreased, still considered a slight seller's market. However, because the demand has not increased as much in LA as it has in Orange County, you will see that this number has declined, but hasn't really declined by that much. Versus here, we're down from 3.2 to it went to 1.9. So this is a combination of homes available for sale and buyer demand. So this is obviously just reinforcing the fact that there is more demand in Orange County compared to LA. So now we know exactly what's happening in the current market. Let's take a look at why Orange County has outperformed LA. We've seen the last 20 years, we've seen during economic booms where the housing market's doing really well, OC does increase substantially more than LA. And we've seen that when times are bad, interest rate goes up, less jobs becoming available, more layoffs occur. LA underperforms Orange County, so it drops even more than OC. So superior school districts are a large factor. Remember, a lot of home buyers, especially first-time home buyers, are families, young families looking to potentially have kids, already have kids, and school districts are an important factor. When you consider the public school system in Orange County, it is substantially better overall. We have places like Irvine, which continue to rank highest in free public schools, and then Mission Viejo, Laguna Niguel, all have some of the highest performing public schools in the entire state of California and consistently ranking in the top tier of state and national performance metrics. So that is something that a lot of families consider when they decide where to purchase a home. Now this creates a demographic-based demand floor. So families who can afford to buy an OC continue to prioritize doing so. And in contrast, Los Angeles Unified School District, which serves a majority of LA County's school-age population, has faced persistent challenges with academic performance, funding, and administration. And all of these factors continue to determine if the local market is going to do well or not. Remember, families are a large percentage of home buyers in California. Point number 2, coastal and lifestyle premium. Orange County has 42 miles of Pacific coastline with world-class communities, including Newport Beach, Laguna Beach, Dana Point, and Huntington Beach. Now, coastal access is, of course, finite all across the country, and in these cities specifically, there really isn't any room to build. So what's available now is really what's going to be available in the future. There isn't enough land to continue to expand, and when you have a fixed supply of inventory, if the demand is there, prices are inevitably going to continue appreciating. Versus LA, which has a larger amount of land, room to continue building homes, that is going to hinder the home value appreciation in that area, because obviously builders are struggling to sell homes right now, and they're really going to do whatever they can in order to get those homes sold in the future by offering discounts and offering huge amounts of credits. So when you're considering appreciation, that is also a factor to determine where you want to buy a home. Obviously, higher income demographics and employment base is obviously going to impact the housing market as well. Orange County has a huge high-paying Orange County has enormous high-paying sectors, including technology, healthcare, finance, and aerospace. And a lot of companies have actually moved their hubs here and continue to hire people with high-income jobs. The median income here was almost $90,000 in 2023, and you really need that sort of income to even consider being a homeowner in this county. Median income is substantially lower in Los Angeles. Obviously, there is a wider range of jobs, of demographics in the area, and it's going to be fewer high-paying, high-income families in that area because all of these companies have moved their hubs. So a lot of these companies have moved their hubs to Orange County. It's like if you look at the Bay Area, San Francisco, there are an enormous amount of high-income jobs there versus Los Angeles as well, because a lot of the tech companies have their headquarters in the Bay Area, and that just inevitably leads to higher paying jobs. Crime has become a large factor when determining where you want to live and where you want to buy a home. And Orange County has 6 of the 10 safest cities in the entire state of California. Irvine consistently ranks as one of the safest cities to live and one of the best places to raise a family. Laguna Niguel is in the top 10. Aliso Viejo, Mission Viejo, Rancho Santa Margarita is an inland city in Orange County, and it recently ranked the safest city in the entire state. So there's all of these factors contribute to home value appreciation as a result of demand in the area. And when you see things like amazing public schools, this city's very safe, it tends to draw in a lot more families, which, like I mentioned earlier, is a large percentage of the home buying pool. Supply constraints and zoning. There's less land available to build in Orange County, and like I mentioned earlier, that is a factor when determining home value appreciating, because if you have more and more homes hitting the market, obviously prices are likely going to decline. Now, obviously, wildfires and insurance risk has been a large factor in Los Angeles. There was $50 billion worth of home values destroyed during that fire, and insurance has become a major affordability issue in the area because insurance premiums have now skyrocketed in a lot of Los Angeles. Now, Orange County, of course, has had its history of wildfires, but generally speaking, there is a significantly less likelihood of something like this occurring in Orange County because there are stricter guidelines and enforced guidelines on clearing out dead debris, clearing out brush, and ensuring that something like this doesn't really happen. So insurance has become something that a lot of home buyers need to consider when they're purchasing a home in areas like Los Angeles, where there was an enormous fire that devastated communities. So where will outperform over the next 5 years between 2026 and 2031? So let's talk about the case for Orange County. So supply remains structurally constrained in most desirable coastal and master plan communities. Like I mentioned earlier, there's just not enough land to build. Irvine zip codes recorded a 9 to 10% home value growth in 2025. So Irvine being that area where a lot of companies are moving to, there's a lot of job opportunity here for people. That is going to drive values higher. And that is really the case for all of Orange County. Because Irvine is so central, you can live in southern Orange County, you can live in northern Orange County, and it's still a pretty short commute to those companies. So the Zillow forecast for Orange County is flat to positive through 2026. And that is honestly in line with my expectations as well. The market hasn't really appreciated over the last year, but a contrast to Los Angeles actually being down year over year in the median home value. Remember, if we look at this chart, a year ago, March 2025, the average home value is $980,000, and it's dropped almost $50,000. So home values are down in LA, and in Orange County, they're up around 2%. You can see they're flat, 1.2 million to 1.2 million. So little to no appreciation versus down 5 to 8%. I'll take little to no appreciation. So the demographics for Orange County homebuyers: high earners, dual income families, and this really creates a floor for home buyers here because you have an average higher income and you have that demographic, which is families who are a larger percentage of home buyers. That's really going to be the driving force for home values appreciating here due to the demand. OC's lower wildfire insurance risk relative to LA. This is what I mentioned earlier. And let's talk about the case for Orange County, for Los Angeles. So Los Angeles obviously has opportunity to grow. The city's outsized role in global entertainment, technology, culture attracts a continuous flow of high net worth buyers from around the world. Now, unfortunately, with this issue that we've seen over the last 1.5 to 2 years, where the film industry has been slowly moving itself out of LA due to a lot of restrictions with filming and really the high cost when it comes to overall production. We are seeing places like Texas grab a lot of this film industry. So that is potentially going to impact a lot of these high income buyers moving to Los Angeles, but we'll have to wait and see how that plays out. Obviously, mortgage rates is a factor that I forgot to touch on for Orange County because it really affects both of these markets. But if mortgage rates decline into the end of the year, that is likely going to spur a demand increase in both of these areas. However, the wildfire disruption has also intensified demand in unaffected, lower risk LA neighborhoods. So you're seeing pockets of LA do really well and pockets of LA do really poorly. And with those lower mortgage rates, the pockets of LA that have been doing well are likely going to continue doing even better. So the forecast for LA is 1 to 4% annual appreciation in 2026, and that wouldn't even get us back to the levels that we were a year ago. So that would still be year over year depreciation in LA versus year over year appreciation in Orange County. So the verdict: over a 5-year horizon, Orange County is the more compelling market for appreciation-focused investors and home buyers based on 20 years of consistent outperformance, stronger structural demand, and lower exposure to emerging wildfire and insurance headwinds that are uniquely pressuring Los Angeles. So that is kind of it for the video. I'm curious to know your opinion in the comments. If you like this video, subscribe for more. If you want to read more about this article, you can check out my website in the description below, where you can also browse for homes, get a home valuation. There's a free mortgage calculator there as well. And if you want to contact me, my name's Ian Phillips. I'm a realtor here in Orange County, whether you're buying or selling. I'll see you next time.